Good evening, everyone. My name is Paul. I'm just going to walk you through the economic scorecard for the first quarter of 2016 for Canada. Now, this is only one perspective. You're more than welcome to go out to other sites like Banks, Stats Canada, to get a different view of what's going on with the economy. Brief bio about myself. I'm CPA, CGA by trade, but I focus strictly on getting information out, as well as what solutions can be done in terms of improving conditions in Canada to support economic growth. Now, my agenda is pretty filled. I talk about from growth rates, GDP, commodity prices, all the major drivers of an economy to give you a perspective of what's going on. I'll be quick here and succinct. Basically, if you look at the growth rates compared now, in 2014 we were averaging growth rates about 3.9% globally. We're now come down to 3.4% for 2017 and 3% for 2016. So we're still seeing sluggish growth rates. A lot of conversations happen from all government officials talking about that other previous governments did a poor job managing the economy. But what you're seeing with these numbers is, despite what's going on, we've had periods of slow economic growth. Economic growth is driven by major things like exports and consumer spending. Okay, if we have a demographic shift in terms of populations, or if we have certain other things that happen in the economy, like a worldwide tragedy or a meltdown or recession, that will impact overall growth rates. So it's easy to say on the surface you look at growth rates, but you have to need to peel back and understand what those growth rates really mean. And that's something that's not necessarily always discussed appropriately. When you look at GDP, which is one of the key measures of economy, is gross domestic product. If you look at where the economy's been heading, we've still seen lots of pressure on the resource side, and basically it's only goods producing side that's only grown marginally, and most of that's been driven by manufacturing over the last little bit. Why? Because we're seeing strong areas like automotive production, food processing, forestry picking up some of the slack, where we've seen the oil sector struggling with price and volume issues, and that's something to bear in mind as we move forward. The other thing is 2/3 of the economy is basically driven by the service sector. Service sector is where you get your retail trade and your government spending. So if governments are under restraint, you'll see some pressure there. If you look at basically the overall retail trade, which shows you a good, healthy economy, it shows you people are spending money, it's been solid in the first part of this year, and that's what's really been driving GDP. This just gives you an idea where we were in terms of commodity prices, as little as on average in 2010 to 2014. And where we're heading this year. We're still struggling to get oil above a consistent price to close to $50 a barrel, which likely will be a struggle into 2016. We can't look at anything and discuss anything other than looking at manufacturing. And the key sectors of driving manufacturing are transportation, food processing, forestry. What's happened is, if we hadn't lost capacity, and that's where we've kind of businesses looked at after the recession, we might be doing a bit better in manufacturing. We lost capacity, we lost jobs over the year. Some of it's through rationalization of companies, other it's to do with policies of various governments that made it provinces or jurisdictions less competitive to other jurisdictions. So when they're attracting foreign direct investment, we're seeing that. Every government comes in with the platform they want to support manufacturing. But what you're seeing right now with some of the policies being proposed, like cap and trade, hydro rates, which are provincial, none of these are going to help keep business competitive, and you have to be competitive in the global marketplace. You also want to position your country to pick up any new restructuring of businesses. There's pressure of bringing nearshoring jobs, which means bringing jobs back to Canada, but you have to have a balance of policy, and that's something that's not discussed significantly. Retail sales, most of this has been driven by big ticket items, which are automotive. They had a strong January. We're seeing clawback since January into February, March. The other area it shows too is there's a big uptick in their home renovation area, so people are renovating their house. Where we're seeing weaknesses are gas station, grocery stores. Gas station makes sense because we're seeing lower oil and gas prices, but the grocery stores, there's significant price competitiveness in there, and it's something to bear in mind as well. Housing market is a key sector because it also shows you wealth, and what we're seeing here and you can't blame the new government in power at the federal level, is there's significant challenges in play with the real estate market. One is housing starts are still significantly very strong here in Canada and the US, and that supports forestry. But it's the fundamental issues that need to come into play. We're getting to a point with affordability of housing to the middle class is seriously being impacted because wage growth hasn't kept pace with inflation and the growth in housing prices. Now, it isn't going to be one policy that when you look at the housing market, because the banks and the government kind of look at the mortgage rates, but it's also coming and look at the whole process from valuations, looking at the debt ratios to people to kind of see how do you make these things more affordable and realistic. And once we start seeing those factors come into play, and with all the resultant policy, you're going to see huge problems. We could see something happen like happened in the mid-90s where people had mortgages higher than their housing value. At some point we may see a market correction because we're seeing 25% now with a lot of banks are saying the housing market is overpriced. If it's overpriced, at some point the market does correct, and it's something to bear in mind when you're making your first purchase and how you're going to support these millennials that are entering the workforce that are still living at home because they're having a hard time finding that first job, but also keeping pace with the price of cost of living as well. We can't talk about any sort of government policy unless we talk about job creation. That's one of the key indicators governments look at and try to toot their own horns at. Now, that being said, the federal Liberals only came into power in November, so they would not have been able to exert a lot of pressure on policy till getting into, say, February or March. Now, they've got their new budget now that's basically a stimulus budget that's focused on infrastructure, which is basically roads, bridges. They're also focusing on clean technology and then public housing. Now, these things are critical to driving construction jobs, temporary jobs, which gives you that blip. But if you don't make key decisions in terms of helping support goods to market, then you're really going to hurt your GDP down over the long haul, because Canada depends on exports. We're a country of 36 million people. If we don't continue to expand exports into new markets, we're not giving business that opportunity to leverage their economy scales to keep competitive, but provide them with new markets. Since the Liberals have taken office, there has been little discussion on expanding trade, which hurts the employment market. What they are focused is on these temporary jobs, but that's a short-term blip with GDP. It doesn't give you the structural changes to support a growing economy to provide the business support for expansion. Wage growth, I just want to show you that we are on track, as everything is said, that we only seen month over month between March and February less than a percent growth in wages. Our inflation rate's about 2.1%. So wages are not growing as fast as inflation. The second thing is we're going to see pressure here from government policies. Ontario is going to impose Ontario Registered Pension Plan. We're going to see cap and trade. Cap and trade will add 6 to 8% to the cost of goods. So that impacts the inflation rate. We're also going to see ORP, which takes less disposable income back because the government of Ontario feels they can do a better job of taking your pension money or helping you save. But it also forces the cost. Businesses are going to make adjustments when they're faced with cost pressure. So you may see more and more pressure on wages as they move forward. Conclusion. We're in a period of rough time now. How things play out now is up to the Liberal government with the way they set their policies. Commodity prices they have no control over. Retail sales will be impacted by people's ability to spend money on their disposable income. Provincial policies the federal government has little control over, other than coming out with the province on an integrated strategy to support business investment. So what's it really mean? Well, over the next little bit, starting in April quarter, to the rest of the next 9 months of this year, we should be watching how the stimulus is going to impact the economy. We should be watching how global pressures are happening in basically countries like Brazil, Venezuela, where we've seen government collapses, where in the case of Venezuela, the government's basically collapsed. In case of Brazil, they're in a deep recession. So how these things play out, I'm going to show you what's going to happen with the economy in Canada in general. Now, the government should never get full credit when the economy does good. It shouldn't get full credit, take the full abuse when it's not doing well. But what you have to do, what most governments don't do, is taking a balanced approach to an economy. You don't want to go all pro-business, you don't want to go all anti-business. It's coming from the center. And we've got significant challenges in play here to grow the economy, to put the conditions here. And part of that means is basically we need to look at pipelines, approval process. We also need to look at how do we expand exports through port development and rail expansion. These are all critical things to drive exports. For each export, with $1 billion export dollars, it creates 5,500 jobs. That's something no government has really emphasized a lot, and it's a critical aspect because, as I mentioned before, Canada is an export-driven economy, depends on export. We depend on trade agreements. Second thing is, you can put money in green technology, and it's a good area. However, it can take 3 to 5 to 6 years out before you see a return in that investment. Yes, it's money being spent on R&D, but it doesn't equate to that product getting to market, and that's something you need to bear in mind. That as you move forward to transform an economy, you can't transform an economy overnight. It takes decades to go through the reforms to properly manage an economy, to transform it to what you want to do for the next policies or the next big uptick in technology, or how you want to move the economy forward. Now, the first quarter was a challenge. Most of what's happening in here, you can still lean back to the Harper policies, because Harper was still in charge in terms of the policies that are impacting here, because any government coming in takes a transitioning period. Starting in April now, this is when we're going to start seeing the liberal policies come in play and how they will impact the economies. So each quarter I will be doing something similar, walk you through the trends to kind of give you a perspective of what's going on in the economy and what's impacting it. Thank you.